Hello, everyone. David and Thomas Moore of Equity Advantage. And this is our first little podcast of the year. So we're talking about a variety of different things we thought might be important. But I think the most pressing probably would be tax reporting on a 1031 at this point of the year, or different issues that may come up for late year transactions. So Tom, you have any comments with respect to people that maybe we started exchanges late last year and now they're looking at completing them sometime in the first quarter? And maybe with that said, what might happen with respect to timelines on that? The 180-day timeline isn't exactly always 180 days. And then with respect to reporting a transaction that spans multiple years, or maybe you received some properties in 2024 and you have some boot received in 2025, or maybe you terminated the transaction in maybe you decide you weren't going to complete it, but you didn't have any right to that money via 1031 G6, and now they're going to be receiving funds in 2025 after a disposition in 2024. All of that.
A lot of questions there, a lot to unpack.
He loves the way I just jabberjaw all the time.
It's something we always need to deal with this time of year. Actually getting into fourth quarter of prior year. Anytime we've got a transaction that is starting towards the end of one year and moving in, it'll carry over into the next year, obviously. First thing probably to talk about would be the reporting of taxes for the exchange, and your 8824 form that is filed to report the 1031 exchange will always be filed in the for the tax year in which you start the exchange. So if you started an exchange in 2024, that's when your phase one closed. You're going to report that exchange on your 2024 tax return in 2025, regardless of when you finalize the exchange. So you might buy all the replacement properties in 2025. It's still a 2024 tax event. That being said, we a lot of times will have people that end up with taxable boot in an exchange. And boot, again, just to refresh memory, is anything that you're getting back out of the exchange that's not real estate. So if you didn't use all of your cash proceeds and got cash back, that is taxable boot. If you maybe used all your cash but didn't replace equal value, and that resulted in you having some debt relief or a smaller loan, that is also taxable boot for the exchange. Those get treated a little bit differently. So if someone were to start an exchange in 2024, escrow sold then, and maybe they had a loan payoff, maybe they had a small loan on a relinquished property, and that payoff date, if escrow closed in 2024, you have got a situation where you had debt relief in 2024. If you go out and buy the replacement property in 2025, and maybe you've used all the cash, but again, that's all you spent. You didn't go up in value, didn't go equal value, and you ended up with debt relief in the exchange. That debt relief is going to be a 2024 tax event. If, on the other hand, you did go out and buy replacement property, and maybe you replaced all the debt, but you still had some cash left over in the exchange, that is going to be cash that you receive in 2025. So you're always going to pay taxes for the year in which you receive your boot. Cash not used in the exchange is going to be received at the end of the exchange transaction. We've gone over this before. We can't release funds to people at any point in time during the exchange, so the exchange has to be finished before we release cash. If that ends up in that following tax year, then that's when that's going to be reported on your tax return.
So if you look at some of this stuff, I think, and you and I have been in this business for 34 years now, if you look at early on, I think, and some of the stuff, if you read the fine print on it, it says 180 days to the due date of the tax return. That was a result of people initiating an exchange with no intent of completing it, just to shift gains from one year to the next, correct? And that's sort of why they made those changes, or in that terminology probably. And so if we look at genuine intent of completing the transaction, what might satisfy that if they ID something? And so it comes back down to like the 1031 G6 rules, right? Mm-hmm. Where when does a person have access or right to the funds that we're holding? And for those of you out there, you need to understand 1031 G6 is sort of the guiding rules on when we can release funds out of an exchange. And it's not a question whether you care whether your exchange is going to be good or not. It's a question of our policies and procedures. So for companies that don't follow 1031 G6, you might just say, well, gee, that company, I'm mad at them because they wouldn't give me my money. And this other, the term accommodating accommodator was willing to just give them the money, and they thought, well, hey, no big deal. Well, you need to understand that 1031 G6, the company doesn't follow those rules. It's not just your exchange that is going to have tax consequences. It's every exchange done using those same policies. So I just really want to stress to people that we really make an effort to let people know when they have access to money. And this is one of those things where the right to funds and the boot treatment on those funds, the tax year is sort of, it all comes together with respect to that. And then just for people, I think a lot of times people don't really understand. I mean, if you've got once again, a great reason to have good tax counsel is they're going to take care of stuff. Don't look at the actual cost of paying that person, but you got to look at the net cost after tax treatment, everything else, because having tax exposure is one thing, taxes owed is quite another, and a good tax person, I think, is one of the most important people there. But I don't think a lot of, some people might not be aware of the 8824. So, what is that thing? I mean, it's obviously reporting for the exchange, but what is it in effect?
Yeah. So the 8824 form is it's a couple of pages long. It's not that difficult to fill out, but it is it's what is submitted with the tax return, and again, it reports the 1031 exchange to the IRS. And really, what it's doing is it's going through and it's asked for certain numbers, what you sold the property for, what the replacement property value was that you received. It asks for basis in the property that you've sold, and so it really determines whether or not somebody has received boot in the exchange. Also to ask if you've received personal property, but it determines whether or not there is boot just for that particular transaction. You may end up with offsetting losses in the balance of your tax return, but it does that, and it also helps to determine what the basis is in the new property moving forward, and which is something a lot of people never know when they come to us. It's something that we always ask people: do you know what your basis is? And a lot of people just don't ever know what it is, and even though they've got tax people that have helped them for years, they may not know what their basis is in property. But it helps to determine what that is for people.
So I think you just made a comment that I think is a very important comment, and as I just mentioned, we've been doing this for a few years at this point in time, and we're blessed to be at a point in our careers where we don't have to do every deal that comes through the door. So I think that one of the things that we take pride in is really, if somebody doesn't need to do an exchange, we're going to tell them. But I think it's rationalizing that transaction, right? I mean, the whole point of a 1031, and our mentor basically, he'd always grind it into us is answer the 3 questions before you buy the property, and then you're making that plan, following through the plan during the time of ownership. So what am I going to make? How am I going to make it? When am I going to make it? But ultimately, the point that was really hammered into us early on was, this is not a tax or legal decision, it's purely an investment decision. The exchange has an opportunity cost, and that's that you got to get deals done within that 45-180. But if you're looking at that, it all comes down to what you just said. I mean, what's the tax liability? What's your basis in the property? And understanding at what point. And made a comment a few minutes ago about having tax exposure is one thing, taxes owed is another. And you also reiterated that in that description there. So I think that really that's the biggest question. I think we do a good job trying to rationalize for our clients whether it's the right thing for them to do. And if it's not going to do it, an example might be, think of the number of people through the years where we're converting properties from investment to residence or residence into investment. And people say, well, gee, my tax liability is X. And so I don't want to pay the tax on this, so I'm going to buy this property, hold it as an investment for a year or two, whatever they deem reasonable, and maybe they had a $25,000 tax consequence, $50,000 tax consequence, but they've got to kick the ball down the road a year. They're living someplace else, putting their life on hold for a year, and that cost of putting their life on hold might be more than the tax liability. So I think when you're looking at exchange companies, you really got to sort of understand there are a lot of companies today that are just there to accommodate a transaction, but they're not going. How often do we get involved in a deal where we're asking questions, or we get involved, pulled into a deal after the fact? People aren't getting answers to questions they've got, or the structure is maybe wrong for what they're trying to do.
Yeah, it comes back to we always are. We've talked about doing transactions where there's LLCs involved in a deal, and I know that you've had conversations with our in-house attorney here over the last couple of days about a specific transaction where there's LLCs involved that have to be broken up, and I've had similar ones also. Well, we have them all the time, really. I was going to say, back to the tax exposure real quickly, that we've got a long-term client that is involved in a transaction right now, and just identified properties, and turns out he doesn't think he's going to be able to buy any of the properties, and it's a situation where he sold in 2024. Now he's going to have a failed exchange transaction. He does have properties identified, so we're not able to release any cash to him. He's going to end up getting all of his cash in 2025, but at least he knows now that he's going to have this big tax burden on this one specific transaction. As we come back to planning, he should be talking to his accountant right now and letting him know that he's got a large tax burden on this one transaction that he needs to deal with, and hopefully they can do other things throughout the year to try to mitigate that tax exposure.
And working with a financial advisor too, right? I mean, if they got some Wall Street losses to offset the gains on the realized as via the boot and all of that, right? I mean, how often do you have a conversation with somebody that doesn't really talk to their financial people, whether it's the financial advisors or the tax people pre-year end, to do exactly what you just said?
It might be a good time to dump some of these things that do have losses.
So offsetting gains with other losses is something, obviously a very valuable tool to be aware of, and that's a planning piece. So as we started off this segment discussing, it's all about deferring gain. So to be intelligent about it, you got to know what the gain is, the tax liability exposure is, to justify whether you want to move forward with the exchange. And I know that through the years, I mean, I think back. Remember back in this is the early 90s, we had a transaction where it was a CPA we were working with, and I believe her tax liability was $5,000, for example. And at that point in time, I think we were charging, I think $1,000 to set up and $500 for each additional up or down, whatever it might be. And I remember talking to her, and it's like, you sure you want to do the exchange? This is your liability, net of our fee. You're saving $3,500 or $4,000. I mean, so what is that worth? And I think back, this may be a decade ago now, where we had a guy that had I believe it was 800 and some odd thousand tax liability, and he just, it's only 800K, so I'm just not going to bother. So we're never going to make a decision. We're never going to assume anything on behalf of our clients. Everybody's got a different pain threshold.
Yeah, you've got that client that doesn't mind that exposure, and then you've got the other client that the difference between their tax liability and our fee might be a couple $1,000s, and they're adamant that they're doing an exchange. They don't want to pay dime one in taxes if they don't have to.
So another, I guess, opportunity or situation where that might come into play is if we're looking at doing an improvement exchange for somebody, right? I mean, if we're looking at that transaction, the additional cost of the exchange and then the additional strings involved with it, I mean, what might be a threshold where it really doesn't make sense to do an improvement exchange? I mean, if you've got somebody doing 10K in improvements, 20K in improvements, 30K, 40, what would you sort of expect to be the floor on where an improvement exchange really makes sense?
Yeah, I mean, because of the additional cost, we usually tell people that spending 20, 25 grand is going to be sort of the break-even point. From that point forward, it's all, it all makes sense. But if you're not spending that much money on improvements, best to just take the cash and pay taxes on it. It doesn't pan out for them.
Yeah. It's interesting because I know we've had many conversations through the years, and as we're discussing, some people are just adamant they're not going to pay a penny, period. That's it. And then others are thinking, okay, well, whatever. And I think right now it is the opportunity cost there. And I guess the other comment is that 1031, it's not all or nothing, right? So how often do we have a transaction that is a partially deferred transaction? I mean,
it seems like there's more of them now than in the past, and maybe that's because deals have gotten bigger and bigger over the years. We've, as you said, the time that we've been in business, we've seen a lot of our clients that we do transactions with every few years. They'll sell, if not sooner. But people build up a lot of equity in their properties, and you get into times like we're in now, and people have a hard time justifying interest rates, or they just don't want to spend all their money on something, don't mind a little bit of tax exposure. So we do have quite a few people that will have some taxable boot, and they've got a partially tax deferred exchange. And maybe it's a situation where they didn't have a whole lot of loan left, and they had a great interest rate before, and now they can't really stomach the higher interest rates. We talk about this all the time. Interest rates historically are not that high really right now, but it's, if you had financing that you obtained 5 years ago on a property and you're having to go out and get new financing now at the new rates, it doesn't make sense, especially at the property values. Property values have skyrocketed, and you have to pay for that and the higher interest rates. A lot of people don't like it. So a lot of people will go into something and say, I don't want to get financing on this. I'll just take, maybe I've got a $50,000 debt relief situation. I'm just going to pay taxes on that and not take out a loan, just own debt free now.
Right. So we're going to take a quick break. We'll be right back. And I want to go back and talk a little bit more about the reduction of debt in a transaction, how it can be treated, what happens with it, and then we'll talk about a couple of other maybe partial exchange issues. So don't go away. We'll be right back. Thank you.